that are moving around. But let's discuss the economy, not just the Indian economy, but even what's happening across the globe. Rob Carnell, Chief Economist at ING Global, joins us now to talk about that. Rob, I know you have an expertise in what's happening across the global economy, but I'm first going to pose the question to you on what took place yesterday. What did you make of the RBI policy that was announced yesterday? Do you think the RBI struck a dovish tone this time around?
Yeah, I think it did strike a very dovish tone, but one that you could say is appropriate given the reasonable strength in the currency and the improvements making in inflation, and the very clear indications seem to be that were things to improve, especially on an inflation front, there could be some interest rate cuts in the not too distant future. So yeah, pretty dovish.
All right, let's come to your area of expertise, really global markets. How would you read the recent fall in US Treasury yields? What does it indicate about the macro backdrop as well as fund flows for the rest of the year?
It's very difficult to say anything too sensible about what's happening to US Treasury yields right now, because the macro backdrop is actually quite a favourable one. The growth numbers look quite good. The labour market in particular is showing signs of strength, and we should get some more evidence on that by the end of the week. The inflation numbers too actually don't look too bad at all. We've got CPI inflation of 2%, and the only real missing part of the jigsaw, which would actually perhaps increase people's concern over inflation, is wages, and I think it's only a matter of time before wages start picking up. So 2.5% against that backdrop of strong growth, perhaps underlying growth of maybe 3%, inflation at 2%, and a future which looks fairly reasonable in terms of central bank policy. The taper is going to take QE to an end by, let's say, October of this year. It's only a matter of time before rates go up. You'd have to think that a more sensible yield for treasuries would be something around 3 right now. But I think there are other things going on. There have been quite a lot of talk about pension funds taking profits. Stock markets are high right now, so I think they're looking at rebalancing and moving some of the profits into the bond market. As well as which, I think there are perhaps some concerns over the overall state of the global economy. It's maybe looking okay, but not utterly fantastic. So that, and with tensions in Ukraine and Russia, they're perhaps increasing a sort of flight to safety in terms of treasuries. That may be another factor that's helping to keep yields low.
You don't fear at all a move out of equity into debt markets?
It's an interesting question. I think a lot of people have been looking for something like that for a while, but the profit backdrop still looks reasonably good. It's difficult to see the stock market making substantial further gains in the United States from where it currently is, and in Europe too. You do have a reasonable economic backdrop, one that, at least in the US case, has been picking up. But it's gone an awfully long way. So making another 10, 15, 20% on the back of this looks tough. Another 5, possible. But I think it's also one of the ideas that people have is that potentially what we might need to see is a bit of a pullback first before we start to see new money coming in greater amounts. So certainly some scope for minor corrections along the way as we push forward. Are the sorts of environments I think we ought to look forward in, one where we're moving out of very, very accommodative monetary policy into one which will increasingly be more restrictive.
So let's talk about the markets that affect us the most, the emerging market setup now. How are you reading that? Not just in general, but where does it look like there could be the highest scope for recovery and growth in the emerging markets?
Well, I think it's very difficult to generalize about emerging markets right now. I think, you had a period during 2013 when there was a sort of global revulsion about the idea of emerging markets based on the prospect of tighter monetary policy in the US. And I think we've passed that. Now basically what people are doing is being much more discerning about their attitudes to the emerging market world. And in particular, the difference between what in the past we might have called EM investments and DM investments seem to have really narrowed. There really isn't a distinction that you could make anymore. So growth rates in the BRICS, for example, aren't looking super impressive right now, and are being challenged to some extent by growth rates in developed markets as well. So it's becoming much harder to go, it's just easy to throw money into emerging markets because that's where the returns are going to be. It's not necessarily that's going to be the case in the next year or two, or perhaps forever. That whole period may have gone. So we may be looking at a completely different environment in which investors are looking much more on a country basis, where looks good, rather than as a sort of, let's compartmentalise the world into emerging market or developed market, because I just don't think that necessarily works. Having said that, there are clearly scope for decent returns in a number of places. I think, for me, where we've already seen some substantial gains and where perhaps there's a little further to go is in the peripheral European markets, those developed market economies that, for a while got traded very much like emerging markets. They have gone a long way, in particular in terms of the bond market, so perhaps that's got a little further to go. I mentioned Russia earlier. Obviously, it's taken a battering recently over what's been happening on the sort of international scene. Were things to improve on that front, you could certainly see some rapid improvements there. China, there's a big question mark over. I think no one really quite knows what's going on there. Every now and again, the authorities seem to throw a little bit more of a dollop of support at China to keep things ticking along, but there are underlying concerns about the banking system, in particular the shadow banking system, and the degree of bad credit out there that I think just leave people a little bit anxious. And of course, India looks very promising right now. We have obviously the resounding election victory, and people are looking very hard at India. A lot of the surveys of emerging market investors put India at the top of the poll for where people want to start putting their money in investments. So we'll see how that pans out.
Okay, top of the poll, India. Well, the event for the week, of course, is the ECB, the European Central Bank's meeting. What's your expectation?
Yeah, well, ECB, and they gave a very, very strong statement at the last press conference, basically said they were going to do something. Now, given what's going on in the backdrop, the inflation numbers don't look terribly promising. The growth numbers disappointed recently, and some of the PMI numbers have been a little bit shabby as well. It's clear that they have a mandate to deliver something. Now, what is that? The sort of indications that were given by Mario Draghi at the press conference seem to be that it'd be moving towards a refi rate cut, and alongside that, a cut in the deposit rates. So what would you likely see in the Eurozone is negative deposit rates, which would be, put them in a completely different position to the US or the UK or any of the other G7 economies who didn't do this. And the only country that's tried this has been Denmark. And the main reason for doing this, whilst it's going to be wrapped up in some sort of excuse about low inflation and why that's potentially a problem, I think the real issue for the ECB is the strength in the euro. They want it softer. They'll wrap it up also in terms of transmission mechanisms to peripheral European countries, things like that, suggesting that low interest rates aren't quite helping in the way they ought to have done. In the end, this doesn't really help on that front. What they really want to do is get the euro weaker, and if in the process of doing that inflation rises a bit, they'll be perhaps a little bit happier. They want the Eurozone economies to be competitive, and a softer currency will help that. It'll help on the export front. But it's not... it's unlikely, I think, to deliver a completely different trend in terms of, let's say, euro-dollar performance. It might cause a little bit of weakness, but everybody's looking for this. So I think much of the impact will be priced in. So Thursday's meeting, yeah, on the day there'll be a little bit of movement, I think, in currency markets. But I don't really think it's going to dramatically change things unless they start adding to that policy in future meetings by undertaking some much more material additions to liquidity, perhaps a new long-term refinancing operation, perhaps even embodying some idea of quantitative easing, which I know is beginning to take ground even within some of the sort of more hardened parts of the ECB and the Bundesbank.
All right, Rob, thank you very much for giving us that perspective, especially on the ECB. Thank you for joining us. So.